Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're discussing when a period of non-qualified use would limit the amount of gain on the sale of a principal residence that's excludable from income. We'll be covering Section 121 in depth in our upcoming Sale of Residence from A to Z webinar on September 28th, and you can get details and get registered at spidell.com under the Webinars tab. Gone are the days when a taxpayer could move into their rental property, live there for 2 years, and then take a full IRC Section 121 exclusion. For home sales after December 31st, 2008, the gain from the sale or exchange of a principal residence is not excluded from gross income for periods that the home was not used as the principal residence, which is the period of non-qualified use. Generally up to $250,000 of gain, or $500,000 for married taxpayers filing a joint return, that's realized on the sale or exchange of a principal residence can be excluded from gross income. The exclusion applies if the taxpayer owned and used the property as a principal residence for at least 2 years out of the 5 years immediately preceding the date of the sale or exchange. But when a taxpayer converts a vacation or rental property to their principal residence, gain on the subsequent sale of the property that's attributable to the period of non-qualified use is not eligible for the Section 121 exclusion. Non-qualified use is defined as any period that the taxpayer owned the property but didn't use it as a principal residence after 2008. The non-qualified use rules didn't come into existence until January 1st, 2009. Non-qualified use doesn't mean that no Section 121 exclusion is available. It means that only a portion of the gain qualifies for the exclusion. The amount of gain allocated to periods of non-qualified use is the amount of gain multiplied by a fraction. The numerator is the aggregate periods of non-qualified use during the period the property was owned by the taxpayer, and the denominator is the total period the taxpayer owned the property. The resulting amount does not qualify for the exclusion, but any remaining gain can still be excluded under Section 121. As an example, Mary, a single taxpayer, purchased a property in 2018. For 2 years, she rented out the property, and then she moved into the property in 2020. After living there for 2 years, she decided to sell the property in 2022. She owned the property for 4 years, with 2 years of non-qualified use. Because 2 out of the 4 years she owned the property were non-qualified, 50% of her gain does not qualify for a Section 121 exclusion, but the remaining 50% does. If she had $300,000 of gain, only $150,000 would qualify for the exclusion. But if her gain were $600,000, then she could use her full $250,000 exclusion. On the flip side, taxpayers who convert their principal residence to non-qualified use, like using the home as a vacation home or rental property for a short period before they sell it, but still meet the 2 out of 5 years test on the date of the sale, can still claim the full home sale exclusion. The non-qualified use provision that reduces the amount of the exclusion for periods when the home is not used as a primary residence applies only to the period prior to the owner's use of the property as a primary residence. It does not apply if the period of non-qualified use occurs after the homeowner used the home as his or her primary residence. For example, take a couple that lives in their home for 3 years and then purchases a new home. That couple could rent the original home for a couple of years before they sell it and still qualify for the full Section 121 exclusion under the 2 out of 5 years test. For this couple, because their rental period occurred after the last date they lived in the home, it doesn't reduce their Section 121 exclusion. You can also stay up to date with tax news at Spidell's quarterly federal tax update webinar. The next session is on October 26th, and you can register for that single session or for the full series of 4 at spidell.com under webinars. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.